Okay, last time we were talking about the CAMELS ratings, this risk rating to kind of tell us the situation the banks are in. The bank regulators come in, federal regulators, examine the banks. They've got call reports where the banks are just submitting data regularly, and then there's also an examination. And from all that information, we get a CAMELS score. And that, as I mentioned to you last time, tells us whether the bank is running a lot of risk or doing a good job keeping risk down so the banking system is safe. And so anyway, one thing I didn't really get to that is a problem with regulations. You know, we've got these CAMELS scores. And one problem is this, is that the regulators don't always do a good job of applying that to the banks. You know, we're sort of assuming here that banks can go out and make mistakes, and then the regulators come in and detect that by doing their examinations and so forth. And that's all true. The only thing is there's one more step in the process that's necessary, and that is for the regulators to say, hey, you broke the rules, here's what you're going to do. Didn't just break the rules, but you're taking too much risk, an unacceptable amount, and we're going to require you to do this or that, and then actually follow through on that. And so that is a problem with all of this, is there isn't such a thing as perfect regulation. And that doesn't mean to say that, oh, the regulators are no good. This would be a problem that anybody's going to have. You know, it's like a matter of having a lot of different issues to deal with. 7,000 banks in the United States, and you can only deal with so many things at a time. The regulatory bodies don't just have infinite numbers of resources. They only have so many people working there. And also there's a change in what you might call technology. So sometimes there are risks being taken that aren't detected. And so we, you know, maybe the CAMELS score doesn't fully reflect the risk that a bank is taking and so forth. So anyway, but a problem with all of this, if everything worked the way it's supposed to, just in theory, we get a CAMELS score. A bank that gets a 1 or a 2 would be told, yeah, you're doing a fine job and we'll see you next time. Banks that get 3, 4, 5, we would tell them this is not acceptable. We'll reach an agreement on what you need to do to bring your level of risk into some acceptable limit. And then the banks would follow through, and then we wouldn't have bank failures. But we do have bank failures, and in some years we have quite a few bank failures. Most years it's a small number, but in a few years we have a lot of bank failures. How can that be? And the answer is all of this theory isn't necessarily put into practice. I was reading something, where did I get this from? The New York Times. And it was from an editorial they wrote a few months ago, but they were talking about lending standards and basically what led up to this financial crisis that really started in 2007 and then continued into 2008 and 2009. So they were describing this process. And here's what they wrote. The damage now becoming apparent demands that policymakers take stock of how the economy arrived at this place. The bubbles in housing and mortgages would not have been possible were it not for the progressive deterioration in regulation over the past several decades. So they're talking about years and years and years that went by, decades, where that regulation of mortgage lending, housing lending, and then, of course, what happened in the housing market, that was just kind of pushed onto the back burner. That's not a big issue. The anti-regulatory ethos, in turn, derived its potency from a pervasive ideology that markets are self-regulating and self-correcting, and therefore best handled with incentives and voluntary best practices rather than rules and boundaries. So I guess what they're saying here is, and it's not only with respect to bank regulation, but also Fannie Mae and Freddie Mac and all sorts of laws passed by Congress and so forth, but there's this issue that in this housing bubble, but the prices that became so inflated in housing, that this was something that was not perceived as a big problem. And it was like, oh, you might be taking risks about lending to businesses. You might be taking risks, you bankers, might be taking risk in the securities you buy. You might be taking risk in many different ways, investing in derivatives or getting involved in that market. But we're not so worried about housing. And so we won't really look at that. And so over the years, these problems built up, and then all of a sudden, a lot of these home loans went bad. that were defaulted on, and also then a lot of the securities that were purchased, the mortgage-backed securities issued by the GSEs and the mortgage banks, or investment banks, but those bonds went bad, lost value, and then the bankers were in trouble. And so this is something that we need to keep in mind as well. To some extent, I already talked about the capture theory of regulation. You know, it can be that all of this stuff is not strictly enforced because to some extent the regulators feel, you know, a kinship with the banks and just don't want to be too tough on them. And that would be this capture theory. But then to some extent, it's what I already mentioned, and that is that the regulatory bodies are stretched thin. They only have so many resources, so many examiners and so forth, so many employees, so much time to go out and look. They're trying to focus their attentions on the worst banks, and then that means that some that are, you know, rated 3 rather than 4 or 5, maybe they skate through and don't really get called to task. Here's another one, and it comes back to this issue of the camel score, but how could it be that, you know, we weren't on top of all these risks? This is another article. By the way, that first one that I quoted from was dated January 31st, 2008. So that was back in the middle phases of that financial crisis. Here's something else. A milestone in the deregulation effort came in the fall of 2000. So now we're looking back a decade. Came in the fall of 2000 when a lame duck session of Congress passed a little noticed piece of legislation called the Commodities Futures Modernization Act. The bill effectively kept much of the market for derivatives and other exotic instruments off limits to agencies that regulate more conventional assets like stocks, bonds, and futures contracts. So we've got bank regulators. We've got the Securities and Exchange Commission. We have these regulatory bodies that are watching over these risky activities, financial activities. And what this says is, in fall of 2000, some of these more exotic derivatives, the new technology, are coming along. And rather than say to the Securities and Exchange Commission and the Federal Reserve Board and so forth, hey, you get on top of this, this is all taken away from them by this law that was passed in 2000. And so the riskiness of these assets was not fully understood, and then we get to a point in 2007, 2008, 2009 when the value of these assets comes down, and then banks and investment banks and so forth get caught up in all that, and we see a lot of failures. This was signed into law, what it said, by a lame duck session of Congress. In 2000, it would have been Bill Clinton as president. And that wasn't something Bill Clinton was pushing, but in his, I think, December of 2000, and so that would have been in his last month of office that he would have signed that. So, lame duck Congress, lame duck president, here comes the bill, okay, let's sign it and go home to Christmas. And so anyway, that's kind of how we get into these sometimes. Let's talk a little bit about the regulators themselves. Who are they? And I've already mentioned each one of these regulators has already been mentioned briefly, but I want to kind of bring the discussion together, you know, and talk about each one. OCC, Office of the Controller of the Currency. The controller of the currency, you recall, was created with this National Bank Act in 1863. Okay, under President Lincoln. The OCC charters and regulates national banks, national banks are just privately owned banks, just commercial banks, but they have a national charter issued in Washington, D.C. by the OCC. Okay? There are 1,600 of these national banks, plus 50 banks that are chartered overseas. There are foreign banks. Okay, and they have branches operating in the United States. But basically, 1,600 U.S. banks have national charters. And that's who the OCC regulates. Okay, and regulation, supervision. The supervision part is watching to see, are you following the rules? Okay, these are typically the largest banks. Typically, I say. And these 1,600 banks hold about 2/3 of all bank assets. So if we got the entire banking system with about 7,000 banks, right? And so here's 1,600 of them, less than a fourth, and they hold 2/3 of all bank assets. And that's a rounded off number. Okay? And these banks, national banks, must, and I'll underline must, be members of the Federal Reserve. They call them Fed member banks. Members of the Fed. And they must have FDIC insurance. Why do banks become national banks? You know, one reason to become a national bank is there's some prestige involved in that. And by prestige, I don't just mean to say the banker can walk around and say, look at me, I got a national bank. But what I mean is this, is that when we're deciding where to put our money, we depositors, and we're thinking, do I want to trust them? Then when we see that word national, maybe not consciously, but subconsciously, we start thinking, that's a little safer place to put it. That's a national bank. And so that's one of the reasons banks do that. Sometimes you'll have a small bank that's not doing big business or anything like that, and they'll get this national charter. It may be that they're a small bank just getting a start, and maybe they think, hey, you know, people aren't going to trust us with their money. They never heard of us before. What can we do to add something that will make people trust us more and give us the money, and maybe that'll help us grow more rapidly? Well, let's get a national charter. Another reason for getting a national charter is it may be that the bank wants to get involved in more sophisticated financial activities. Okay, and it may be that they want to open branches in other states or even other countries. And so once you have in mind doing these more sophisticated things or spreading yourself, you know, into other areas, into other markets further away, then the national charter is something that's more appropriate as well. Okay. By the way, I mentioned about the prestige or the safety that's attached to just having that word national bank. And that is for sure done. Something else that I used to hear, I don't hear it so much anymore, but used to hear people mention was when you walk in a bank, sometimes you'll see these big marble columns. You know, there's a very high ceiling and these big marble columns, and sometimes, you know, the marble floor and things like that are granite. And you think, oh man, this is solid. And so then it wasn't a joke, but the understanding among bankers would be, yeah, we'll put that in there and that'll make people feel like their money's safe. You know, now that doesn't mean that we're managing it safely. It doesn't mean that nobody could rob the bank. It doesn't really mean anything other than we've spent a lot of money on these marble columns. Okay, but there's this subconscious feeling that people have when they walk in and they see these big columns and that high ceiling, and you just think, wow, this is solid as a rock. I'm going to give them my money. And so anyway, part of the reason that we see those big buildings like that is to give us this feeling, and it's usually subconscious. There's nobody got to sign up, I guess nobody, that says solid as a rock, you know, leave your money here. But there's that feeling, solid as a rock, that we get, and then we go, I feel good about that bank. I don't know if you see these, but a lot of times there will be a new bank, it gets a charter, and the first thing they do, they get a charter, and it takes time to build a building. And so what they'll do is they'll start their office out of really a mobile home. Have you seen those? And they'll just bring them right up on the lot, and then, like, there it is. And it would take, like, a can opener to break into one of those. You know what I'm saying? Just get there and go like that, and then just all the way around and just crawl right on in. Anyway, a can opener. You don't see a lot of, you know, bank robbers that are outfitted with can openers, maybe something electric so you can get in and out. What do you think? Electric?
Most definitely.
Yeah, plug that in, would you? Anyway, how would you feel about that, though? I mean, really, if they have insurance and you give them your money, and if they get robbed by somebody with a can opener, then you don't lose anything. They have insurance. So would you feel good about that? Would you feel good about having a bank? And I don't mean to say temporarily, but just permanently in a mobile home out on some lot with maybe no grass or anything like that. And you just walk up there and take 2 or 3 steps up and go in and say, here's my money, and then leave. How would you feel about that? And most people are going to go, nah, I don't think so. But I mean, theoretically, if they're paying you interest and treating you in an honest way and give your money back when they promise, and it's all the same, right? But people, I think most people don't feel good about that. I don't know. And then when the bank grows, they would get a double wide. I'm just making this up because, somebody has to. Okay, so anyway, here's our first bank regulator we want to talk about. Let's talk about a second one. And I'm going to focus on, there's the order, why I'm going to turn to number 2 is the state banking authority, is because of the chartering. And I'm not going to write all this stuff down again, but it's they charter and regulate state banks. And by the way, I mentioned to you that if a bank has that word national in its name, it has a national charter. They don't have to use that term national in their name if they have a national charter, and banks that have a state charter usually do not have the word state in their name. Okay? Now, we have about 7,000 banks. We know there are about 1,600 of them with national charters. How many do you think we have with state charters? Those of you who want to do the math at home, we have about 5,400 banks with state charters. These tend to be community banks, right? Okay. And by the way, we have most of these 1,600 nationally chartered banks are community banks too. We have of the money center banks and the regional banks, maybe 400 or 500 money center and regional banks, 400 or 500. Most all of them, not every one, are in this group. And so roughly 1,000 or 1,100 or 1,200 of these banks right here that are national banks are community banks. They're not huge. Okay. So anyway, 5,400 banks. Okay. This turns into, how many states do we have? 50. So this is about 100, a few more per state. I told you that we have around 300 banks in this state. What a state. Okay. And then what? Fed membership is optional. FDIC is usually FDIC insurance on foreign deposits, usually required by the state authorities. That is to say, you go and say, hey, I want to get a charter, and they say, okay, go get FDIC insurance. And if you say, I don't really want to do that, they go, okay, we really don't want you to have a charter. Why not? Because the chartering authority in your state, they do not want a lot of uninsured banks around the state because they're just waiting for a disaster. The bank fails, depositors go, oh my gosh, I can't get my money back. I think that we'd have to go back to the late 1980s, I believe. It's hard for me to know. I read a lot of stuff about the history of it and so forth. But I think if we go back to the late 1980s, there were still several states, 5, 6, 8, 10, that had their own deposit insurance. And so then the banks would have deposit insurance issued by the state, some state authority, and not by the FDIC. And what happened was here's the deal. If you get a bank or two that fail, and assuming they're not huge banks, then you can go into the state insurance fund and pay off depositors or handle those problems. But if you have some recession that is really severe and you have 20 banks that fail, it's like that wipes the system out if it's done on a state level. So anyway, the states at that point paid people off and just said, that's it. Now, go get your insurance from the FDIC, and if you don't want to do that, then just don't do business in this state. And so anyway, the requirement of getting FDIC insurance would come from these state authorities or from the National Chartering Authority. And it's always been the case since there was an FDIC. As soon as they said FDIC exists, in what year? The law in 1933. Since that year, every national bank has had FDIC insurance. And it's been in more recent years that virtually every state chartered bank has FDIC insurance. Okay. I mentioned a term before. Let me throw it in here again. Dual banking. We have a dual banking system. And the dual banking system means you can get a charter in Washington from the OCC or a charter at your state level. Okay, and so we've got two sets of basic chartering authorities, two sets of regulations, and there was this tendency to shop around for lax standards. And that's not nearly as much as it is, but if we go back 50 years, 75 years, 100 years, then what would happen is you say, yeah, let's start a bank. And then you'd say, what do you have to do to get a national charter? And they'd say this and this and this, and you go, I don't really want to do all those things, hold myself to those standards. What would I have to do in, the state of, just pick a state. How about New York? Boy, that's a lot of standards too. Well, what about Delaware? Well, I don't like to hear the sound of that one. What about, and then just keep going. There's 50 states, not 100 years ago, but there are a lot of states, and just keep looking. You finally say, boy, these guys have no standards at all. That's where I want to do business. Now, that would be if you were maybe not a very good manager and not totally ethical. And so then, if banks are going to that state and getting their charter, then other states nearby might say, gosh, banks don't want to open up here. They're going over there because their standards are lower. And then there's a tendency to, let's compete. Let's lower our standards a little bit. And here's a rule or two that we had that maybe we can get rid of it. And then that state starts attracting more banks. And then the next state says, yeah, we ought to do that too. And so this whole idea was thought to sort of bring about a competition toward the bottom in terms of lowering standards. But over the last 20 years or so, it's really gone in the opposite direction. One reason for that is no matter what these chartering authorities say their rules are, we depositors have our own rule. And basically, our rule is this. I'm not putting my money in a bank that doesn't have FDIC insurance. And so if we say, I'm not putting my money in any bank without FDIC insurance, then even if these chartering authorities had no standards, and just said, do what you want. As long as the FDIC says, we have standards to get insurance from us, then that would prevent these banks from engaging in all sorts of risky, sort of shady activities. And so anyway, this shopping around for lax standards is a historical problem that is not as severe anymore, not nearly as severe as it used to be. But we still refer to this terminology as a dual banking system. It is unlike banking systems, banking institutions in most countries of the world. Most countries are going to have the equivalent of a controller of the currency, national charters. If you want to open a bank in France, you go to Paris, you get a charter, and then you bank in France and wherever you want to be. Okay, and sure, I could throw around a few French names just to impress you, but I'm not going to do that. Okay, the third banking authority. Federal Reserve. And officially the Federal Reserve System. And we always call it the Fed. So then the Fed, these are called member banks. The banks that join the Federal Reserve System, they go in and they apply, say, I want to join. And those banks are called member banks. Sometimes they'll be called Fed member banks, but just member banks. Okay? It includes all of these nationally chartered banks and, in general, the largest of the state chartered banks. And I'm just saying, in general, any bank can apply. And as I said before with the national charter, you might say, hey, there's some amount of prestige or safety or whatever involved with being a member bank. Let's become a member bank. And there are some services provided. Okay. These state chartered banks that are Fed members tend to be, let me say this so you understand, the state chartered banks that join Fed membership tend to be as big as the nationally chartered banks. So it is, as a rule, the largest of the state chartered banks that become Fed members. Okay, there are about, I'm going to put a number up here, 700. That's a ballpark number, but there are about 700 state chartered banks that are Fed member banks. You remember there are 1,600 nationally chartered banks. So what's that add up to? 4,000? Anybody say 4,000? About 2,300 member banks of the Federal Reserve System. Okay. Well, let me go back. These 1,600 nationally chartered banks are holding 2/3 of all the bank assets. And so now if we go pick up another 700, tends to be fairly large banks, then what we're saying here is that, and I don't know the exact number, but a very high percent, I wouldn't be surprised if it's 90% of all bank assets are owned by or held by the banks that are Fed member banks. And I'm not telling you that it is 90%, but I would not be surprised by that. These tend to be our biggest banks in the United States. But there are community banks in there. There are, what I told you, probably 1,000 or more community banks in this group of nationally chartered banks. So it's not like they're all big, but on average, these are pretty big banks. Okay? Why do you get Fed membership? Well, here's what you do. Number one is if you have Fed membership, you have an account at the Federal Reserve, and that's where you keep your reserves. You can keep reserves in the vault, but you don't need a lot of cash in the vault, and so then you keep your reserves at the Fed. And the good news about that is if they're at the Fed, they can be transferred quickly, right? Another thing is you might want a service the Fed provides, which is check clearing services. Bundle up your checks, hand them over to the Fed. Really anymore, it's electronically, send a picture of them to the Fed. But anyway, you get your checks to the Fed, they'll clear them, or they'll collect those for you, give you credit into your account. I've been to the St. Louis Federal Reserve Bank and seen those machines they have that do the check clearing process, and they are monster machines, and they put a big stack of checks on there, and they suck them through, so fast it's hundreds a minute, hundreds and hundreds per minute, and they got lots of machines, and in the course of a day, they can clear millions of those checks. And they are not, the Federal Reserve is not the only one clearing checks, but because some large banks do their own. But the point is they have the biggest machines that are the most efficient. Okay. One of our graduates that took this course several years ago, but an econ major here at this university, worked up there and was actually in charge of that department. That's how I got to go through the room and sort of stand up next to the machines and watch them, move so fast. And it's really just an incredible process. But anyway, that is a service that pretty much all banks need, is check clearing services. And so a lot of banks will join for that service. I mentioned to you before, and so I'll come back to it again, a bank, with regard to national banks, a bank that wants to get involved in more sophisticated activities and a bank that wants to do business further from home, those are the types of banks that find rules and regulations that would govern that kind of activity. And if you want to do these more sophisticated things, far from home, and you just want to have a state charter and no Fed membership, you start saying, oh, I want to do this, and the regulator in your state says, we don't allow that. You want to involve yourselves in certain derivatives, financial securities, or you want to open a foreign branch or whatever, we're not set up for that. No. And so then once you start saying, this is what I want to do, then you start saying, we've got to have a membership at the Fed, or we need to have a national charter. Fed membership is required of national banks, and it is an option, I'll put it over here, an option for state chartered banks. Okay, but it is absolutely every national bank, since there's been a Federal Reserve, every national bank has to be a Fed member bank. Okay, what else did I have in my notes here? All Fed member banks, must have FDIC insurance. FDIC insurance coverage on deposits. And the Fed regulates BHCs. You remember what those are? Bank holding companies. So in addition to regulating member banks, and the Federal Reserve has regulated these member banks since they opened their doors. When? 1914. So since 1914, the Fed's been regulating member banks, but you remember we had two Bank Holding Companies Acts, one of 1956, and the other, do you remember the year? 1970. And so those Bank Holding Company Acts of 1956 and 1970, they are the ones that said to the Federal Reserve, you regulate those bank holding companies. And there was a big movement underway. 1956, the big movement underway of creating bank holding companies was to get around the laws on branching, that restricted branching. Oh, let's open more offices. Well, you can't. Okay, so we'll have a bank holding company, and it will open more banks, not branches, but separately chartered banks. And so, anyway, so we get the Bank Holding Company Act of 1956. It regulated multi-bank bank holding companies. And then we've got a bunch of banks that before 1970, the movement gets underway. Let's create bank holding companies to get around Glass-Steagall and get into other activities. And then along comes the Bank Holding Company Act of 1970 to regulate banks getting into these other business activities. So we've got the Federal Reserve regulating bank holding companies. How many bank holding companies are there? There's about 5,000 bank holding companies. And so what we have is, and really what you can say is every bank that is large or medium size or even on the larger part of small. Did that make any sense at all? Because many things I say don't. 5,000 out of 7,000 banks are owned by bank holding companies. And what we had, I said like maybe 90%, maybe, of all bank assets are held by these 2,300. Well, there's twice that many banks that are owned by bank holding companies. And so really, just the smallest banks are not owned by bank holding companies. So this puts the Fed's finger in every pie in the country, so to speak, of regulating banks. And finally, number 4, and I know you were waiting for finally, the FDIC. Oh, by the way, before I go on to that, I was talking most recently here about the bank holding companies. I printed out a list. I'm not going to pass it out, but just on one page I printed out 28 bank holding companies. And the largest bank holding company is the Bank of America Corporation that owns Bank of America. Okay. I don't know if you recall, but I was telling you that Bank of America, the bank, has total assets of, what did I say, either 1.1 or 1.3 trillion dollars. We talked about that the other day. Well, the bank holding company that owns Bank of America has not only those assets, but the assets of subsidiary operations that are not banks. Bank of America Corporation, total assets $2.3 trillion. So this corporation, this bank holding company, has got $1 trillion in assets outside of banking. And they're doing all sorts of other activities that are simply not banking. For example, investment banking or loan companies that lend money to people but not lending money to people that are derived from deposits, but just other small loan companies and things like that. J.P. Morgan Chase, slightly over $2 trillion in assets. This is J.P. Morgan Chase and Company, the bank holding company that owns J.P. Morgan Chase, the bank. Citigroup, the bank holding company that owns Citibank. Citigroup has assets of $1.9 trillion. So, huge corporations, right? Anyway, so there are about 5,000 of these. The 28th largest, and I'm not even going to name it, but the 28th largest has total assets, bank holding company, of right at $70 billion. So we're talking trillions and trillions of dollars in assets. Okay, FDIC. I've already mentioned this to you in another connection. All Fed member banks and all nationally chartered banks must have FDIC insurance, and then also almost all state chartered banks must have, because the state chartering authority requires it. Okay. And out of the 7,000 banks, I don't know the exact number, but we're talking 6,800 out of 7,000. I'm going to put a question mark there because I don't know. The banks that have a bank charter and do not have FDIC insurance, most of them are what I've told you before, are non-deposit trust companies. A non-deposit trust company that does not accept deposits, therefore they don't need insurance, deposit insurance. But anyway, a non-deposit trust company, and they are managing people's money for them, but they have a bank charter. And because today, if you go out, I mean, we've had a lot of bank failures and people have lost money from this. If you went out today and put up, a big building with big marble columns and things like this and say, we're now accepting deposits, no FDIC insurance, people would say, no way. I just am not interested in putting my life savings in your hands and hoping for the best. Okay, so anyway, virtually all is the way I normally say it. Virtually every bank in the United States has FDIC insurance. To qualify, the bank's got to do two things. It's got to meet safety standards, and operating standards to lead to safety, like these CAMEL scores and so forth. But you've got to be safe, and then you've got to pay your premium. And then all the other things about can you open branch offices and things like that, that would fall under the heading of other regulators. Okay? And as I mentioned before, the FDIC is the only regulator of state-chartered non-member banks. So if you get a state charter and you don't join the Fed system, then your only federal regulator will be the FDIC. And so that is setting a floor on standards. As long as the FDIC does its jobs, then we're not going to have the riskiest operations out here taking people's deposits. And in recent years, they, like all the other regulators, have faced some challenges doing that. Okay, let me draw a little picture and then we'll go on. see if I can put this all together. So we have about 7,000 banks. We have 1,600 with national charters. 5,400 with state charters. And that gives us our 7,000 banks, more or less. I'm rounding off. Of these 7,000 banks, we have, what did I tell you, 2,300 that are Fed member banks. And we have, what's the rest? 4,700 non-member banks. And all of those national banks are Fed member banks. And then out of those, every one of these Fed member banks has FDIC insurance, and virtually all have FDIC insurance. So, and I made up that number a moment ago. I don't know the exact number today, but 6,800 FDIC insured banks. And these 200 over here are non-insured. They all are, every non-insured bank is a non-member, not a member of the Fed, and state chartered. And I even told you that most of those banks, as far as I know, all of them, are not taking deposits. They are trust companies with a bank charter. Now, here's the deal. Every bank then is going to be regulated, supervised, regulated, examined by some federal authority, except for these 200 or whatever. Yes, sir. A credit union has a different kind of insurance. They're regulated in a different way, and I do not mean to include credit unions or savings and loans, thrift institutions, they're called. Here I am just talking about commercial banks. But a credit union's got something called NCUA that provides, it's not really deposit insurance. With a credit union, I don't know if we talked about this early, but perhaps, if you have an account at a credit union, you go in and you say, here, I want to put this in my checking account. That is not really a checking account. It looks like a checking account. You've got a little check you can write and so forth, but that's really called a share draft account. And so when we put money in a credit union, let me back up, credit unions are not owned by shareholders and then operated to earn a profit, and then we've got customers that come in off the street to buy checking account services. Credit unions are owned by their members, right? And the people who give them money, in fact, if you say, I want to put $100 in the credit union, that's treated as an investment, like you are buying into the credit union. And so then when you go out and write that check, you're not really saying, take money out of my deposit. You're really saying, sell my shares of ownership in that institution, and then take the proceeds and honor this draft. And so that's called a share draft. So anyway, what I'm saying to you is this is really not deposit insurance that we're providing for people. Well, we're insuring your shares. We're ensuring that when you write a draft, this is all legal fictions. If somebody hands you a check, you look at it and you look at a bank check and they look the same. But they're really ensuring your ownership. So when I say FDIC, though, there are different standards, different body, a regulatory body, and so forth.
So it's a completely different pool of money.
Different pool of money, different numbers, different rules, and I mean, almost nothing I've ever said this semester refers to credit unions or thrift institutions, savings and loans, mutual savings banks. There are, 1,200 more or less thrift institutions or savings and loans, about 1,200 that are on top of the 7,000, and around, I think, 10,000 credit unions.
So can they make commercial loans?
Can they make commercial loans? Well, it depends on what the rules and regulations are. But a credit union, for example, is not accepting demand deposits, in theory, right? So anyway, it's... Also, credit unions don't have to pay taxes. And, and so like if they generate a profit, what they do is they hand that back to the shareholders, and you pay income taxes on that, so they don't pay taxes. And a lot of credit unions don't pay rent because, like, it might be that a university or a school or a manufacturing company, they might have a credit union and say, hey, we'll give you free office space here. And so it's really a different kind of an animal. Let me finish up with this. Except for the small number of banks, every single bank has at least one federal regulator, but some have three: FDIC, the Federal Reserve, and the control of the currency. And so this could require enormous resources from bankers turning in forms, basically hosting these bank examiners that come in. And so not only would it require a lot of resources on the part of banks to comply, but also it would require a lot of bank examiners, stuff like that. So what happens is the FDIC and the Fed and the controller of the currency, they all get together and share information, and they share responsibility. And one of them says, like, oh, I'll go see these 1,600. And another one says, I'll go see those 700. And another one says, I'll go see those others. And then we'll share all this information. And then that keeps basically the costs of regulation down, not only the cost, as I say, for the regulators, but also for the banks that are being regulated. We're going to try and finish this material up on bank regulation next time. So long, I'll see you.